I'm John Cobb, and I'm Director and Co-Founder of Trinity Wealth Management, a firm of financial planners based in St Albans in Hertfordshire, been in existence since 2001. Let me ask you a question. It's a question that's often asked of me. What is the best investment? Well, if one has a crystal ball or hindsight, it's an easy question to answer, but unfortunately most of us haven't. So perhaps a better question is to ask, why and for what purpose am I investing this money? And that's really what we call financial planning. And at Trinity Wealth Management, we encourage our clients to firstly do financial planning, to determine what are their financial goals, and to decide how much money should be placed towards each of those goals. Now I'll go on and talk about some of the investment principles that we apply to our investment management, but the first thing is financial planning. Investment management is the solution which helps you achieve those goals, but it starts with financial planning. But let's look at some of the principles that we do apply. The first thing is we look and see whether you are looking to invest, to save, or to speculate. Because we believe that there's a subtle difference. If you're just looking to save, well, that's effectively cash, bank accounts. We don't really feel that we can add much value. That information is out there, on the internet. Similarly, if you are a speculator, hungry to see very high returns over very short periods of time and prepared to take high risks, again, that wouldn't be an area where we feel we could add value. However, for the majority of people, and the people that we feel that we can help, they have a specific time frame and a specific goal which they are looking to invest their money. And that's the kind of people that we think we can help. Then, once we've done that, it's important that within the investment that we look at things like charges. Charges are quite a hot topic. Let's just give an example, which you'll see now appearing on the screen. Let's say within your investment portfolio, you have an investment of, say, £10,000 in a fund, and the fund manager is charging 1.2%. Let's say similarly you have another fund which is charging only 0.3%. And over a 30-year timescale, they get exactly the same return. You can see from the graph that the difference in the return that you receive in your pocket is quite marked. One is over £50,000, the other about £40,000, and that's a difference of 22%. The next thing to consider is the time that you are invested. Over a period of time, the risk of, for example, the stock market, equity investing, stocks and shares, that kind of thing, diminishes over time. So it's really, really important that you know how long your timescale is. This has everything to do with risk. So let's just say that you are investing towards a child's education costs in 6 or 7 years' time. Or let's say you're a 40-year-old and you have a pension fund and you're looking to retire in 25 years' time. Now, many financial advisors will give you a questionnaire when they first meet you. And this would be to determine what is your attitude to risk. And then they'll come up with an answer. You'll be above average, medium, balanced, these kinds of words. Again, great many advisors and investment managers have model portfolios. So let's just say that those two examples, the person saving for some education costs in 5 or 6 years' time, and someone who's got a 25-year time frame, come out both as balanced risk. Should they be in the same portfolio? Consider the graph that's being shown to you now, and this shows the effect of equities over the long term. Now this is taking the American stock market from 1900 to for the next century, and it's showing the different returns you can get. If you invested for just 1 year, you may have been lucky. It may have been the year where the return was 53%. However, it may also have been the year where your return was minus 37%. But as you can see, as you move along that graph, the greater the time scale, the less chance there is of you losing money, such that you get to a point where history says, based on this particular example of this particular stock market, that you will have made money above inflation. Therefore, if you are investing for the long term, as the chap who I said with regards to the pension, it would make more sense that even though he's balanced, that his balanced portfolio has far more equities than the person saving for the education costs. So the effect of time on the volatility of the stock market matters. It means that you can have peace of mind when there are stock market crashes if you have this clearly defined goal and time scale. The next question that people often ask is, which is the best investment fund manager? Well, here's a question. Why do we need an investment fund manager to actively manage your funds if the market that they're in has inherent value in it anyway? I'll give you an example. There are hundreds and hundreds of investment funds out there that invest purely in the UK stock market. And there'll be names that you'll be very, very familiar with. And their job, their remit, is to try and beat, typically, the index of the major companies listed on the London Stock Exchange. That's the FTSE All Share. So if they beat the FTSE All Share, that's great. And if they don't, then they consider that a failure. However, what if the FTSE All Share gives you value anyway? It gives you a return that is sufficient for you to meet your financial planning needs that were determined between you and your financial advisor right back at the beginning. If that's the case, why would you need to take any more risk? Because a lot of the time, it's not the decisions that are made by the fund manager which they get right that impact the portfolio. It's the ones that they get wrong. Because when they get them wrong, that can have such an adverse effect that they are unlikely to beat the index. And here's a statistic for you. Over a 10-year timescale, 88% of fund managers fail to beat their respective indexes. 88% of fund managers. That's with regards to UK and European fund managers. So your advisor has to have the skill of picking the 12% that are getting it right. And I don't actually believe that that's physically possible. But if the index gives you value anyway, why take that risk? So at Trinity Wealth Management, we believe where possible in going for what we call passive or indexed tracking funds. These are cheaper by a long, long way, and they also provide value anyway. But you've probably heard the expression, don't put all your eggs in one basket. So finally, what's really, really important is that you have a diverse range of assets within your investment portfolio. So a portfolio shouldn't just be made up of equities, it should be made up of equities, fixed interests, that's gilts, that's loans to companies or to governments, property. But it's getting that right that is really the skill of the financial advisor. Now that's easier said than done. Look at the graph I'm showing you now. That looks a little bit like the tiling in my kitchen. But you'll see there's no set pattern between which of the asset classes in each year do particularly well. It moves around. And when you add into that investment behaviour, which is typically that we chase returns, ultimately we end up getting that wrong. So again, a disciplined approach What we do know though is the level of risk that each of those asset classes have. So we're applying the right level of risk to your portfolio, and that's what creates the right portfolio for you. The closer we get to achieving that goal, we'll obviously reduce the risk and have more in lower risk investments. Investment management isn't really rocket science. It requires a discipline and it requires an advisor. If this has been of interest to you, please do continue to look around the website, or alternatively click on the link below. Thank you.